Hey traders, welcome to Charts and Coffee. Great to see everyone. Happy Monday. Happy Monday. Hope everyone had a good, relaxing weekend because this is going to be definitely an interesting week in terms of volatility and in terms of high impact macroeconomic events. We've got non-farm payroll on Friday. We have both the ISM services and manufacturing. And of course, on Wednesday, we have the FOMC. We have the May 4 meeting where we're looking at very least, a quarter point hike coming up in just a couple of days here. So no doubt we have a lot going on. And I think more than that, I know for me and probably many for you, but I know for me for sure, in terms of a lot of those great trends. So the last 2.5 months have been very, very good because we had inflationary trends, we had commodities trends, we had commodity stock trends that had been moving in a really, really, I want to say predictable. So I hate to ever, I don't want to do that. There we go. There we go. In a really predictable way. And I don't know that ultimately, I kind of screwed my screen up here. Bear with me. All right. In a really predictable way. And what happens when we start to break trends? And I'm just having a terrible time trying to keep my screen now cooperating here today. Clearly, I did not caffeinate enough. Just bear with me. I love my matrix background, though. There it is. That's what happened to it. All right. So what we have is kind of what I call, sadly, the one last trend trade. And what does that mean? Every single trend eventually stops. And I know that sounds ridiculously obvious, but it's true. It's never fun. And because every trend stops, there's going to be that one last trend trade. There's going to be that one last dip that doesn't hold. There's going to be that one last rip that doesn't hold. And when we have events like that specifically, what happens is that, well, we get stopped out. But I think more important than that, that means we have to rebuild our watch list. And that's really been a big part of what I've been focused on the last, I'd say, week. Because if you go back on the calendar, all right, let me bring the calendar up here if I can. That's screwing my screen up again. All right, let's see. So you go back on the calendar and you go back into April, which I think is really where we're talking about most of this happening. There we go. There's April. Take a look. Really starting at about the 21st, 22nd, we had that volatility. Oil stocks sold off. We saw that grains even got weak. We saw miners get absolutely crushed, steel stocks. A lot of those great miner and commodities names, the trends are broken. And so that's where we have to remember two things. One, this is why position sizing and risk management is so, so very important. And two, this is where we remember that ultimately, again, because all trends eventually end, all trends will transition to chop, we have to be able to let go wanting to get back into those names because for the most part, they've been good to us for months. And the first thing the brain wants to do is get back in because it's sort of this thing that we know that has been good to us. But really the trick is to almost have a pause on anything that stopped you out from the entire trade and say, you know what, there's probably something better somewhere else. And that's probably the most difficult discipline to develop. So I thought I'd take a moment to say, hey, yes, we are once again after what's been about 8 to 10 weeks of really steady trends. We're in a state of flux. And I'm not even talking about the broader equities because those have been in a state of flux really all year long. So this is not a commentary on the S&P, the NASDAQ, the Dow. They've been a choppy sort of mess for months and months. So this is nothing new. The question that I do get a lot is, Rog, where's the floor? Okay, let me state the obvious. Nobody knows. Nobody knows the high. Nobody knows the low. So to even entertain me to even entertain that answer is just absolutely borderline delusional. However, we can say, where has the floor been before, and what's the underlying market trend? Now, one of the things that I included on the notes yesterday was that the NASDAQ has started that double red bearish momentum, bearish trend structure. The S&P is hanging on by a thread, maybe gets an oversold bounce from the Darvis because it's still neutral. But if we think about what's happened in financials and in healthcare, we talked about this briefly during the Sunday Notes Live. We take a look at what's happened in those corners of the market, those sectors, to say that it's pretty inevitable that the NASDAQ, the S&P, and maybe even the Dow eventually succumb to a red over red structure. Bearish momentum, bearish trend is probably not too far-fetched. So if there's anything that we need to really emphasize all the time, but especially right now, for me, the emphasis comes down to, are we paying attention and respecting the watch list? Are we starting there? Not a new secret squiggle, not some special secret strategy that's so great. No, it's about, are we rebuilding the watch list? Gang, that is going to be the needle mover. So I hope that helps. But as always, the show is about your questions. Those are some of the common questions that I received over the weekend. So I thought, you know what, let's address those right away. And we'll get on to your questions from this morning. All right, kicking it off with Kevin. Happy Monday. Given all the hot zones this week, would it be wise not to enter new swing trades? Kevin, I think that when we have data-based hot zones, FOMC, earnings, all of these, I call hot zones because they're scheduled, they're high impact, and they're high volatility. And the idea is for me to acknowledge that on the calendar, there are events that are going to absolutely create these more trickier market scenarios. So the best way that I know to deal with any kind of hot zone event is to do so after the volatility. So if we take advantage of the lead up, there's that window, days to weeks, depending on the hot zone itself, the lead up into the actual event. And then after, there's another opportunity. The part of it that I absolutely do not recommend anybody do is this, well, let's make a guess on what the FOMC is going to say. Let's make a guess on what the earnings are going to be and put in a position that tries to take advantage of the volatility. So there's the pre-volatility, there's the post-volatility, and there's the during the volatility. It's that during that I want to avoid. So to your point, only after. And mostly the two major hot zones are going to be, of course, Wednesday's FOMC and Friday's non-farm payroll. So I think after would be wise. And if we end up really sort of tapping the brakes, I know in the mastery, I'm going to spend a lot of time tapping the brakes this week. This is really reminding me of what we saw in January, where we tapped the brakes for a little bit to rebuild the watch list and wait for the trades to come back to us. So what I want to do this week, Kevin, is I'm going to be rebuilding the watch list in the mastery, rebuilding the watch list for my futures probably as well. See what's still valid after the weakness or the trend breaks we saw the 21st, 22nd, the week prior, not last week, but the week before that, Thursday, Friday, and then say, all right, what survived, what's still intact? We still have shorts. We still have some productive shorts and things like ITB, Toll, we're short financials. But what's happening is now it's feeling like a normal market. And I remember telling the mastery members, gang, this is not normal. It's not normal to have this many trends, just keep going and going and going and going. We're going to have paper cuts coming. And now I think a lot of members are seeing, and traders in general are seeing, wow, what is the difference? Watch list and position sizing. What is the heartbeat of any trading that I do? Watch list building, position sizing. So thanks for the question. Good stuff. Good morning, Giancarlos. What do I think about UNG? Well, when we talk about commodities, UNG is one of those corners of the market that's actually fared pretty well. And what I mean by that is it's still able to hang on to a bit of a trend despite a lot of the weakness in energies around crude and gas and oil stocks. This is still a great looking trend. FCG, XOP, those are going to be the corners of the market that will go along with UNG, or for my futures traders out there, the natural gas futures. So what do I think about it? Buy the dip is still absolutely valid. Giancarlos, yes, I'm okay with buy the dip. And one of the aspects to natural gas is a bit of a seasonal aspect. And seasonals, for those of you that are in the mastery, today is our third bonus session where I'm going to talk about patterns, volatility, time, seasonal chart. So many patterns out there. I look at patterns a bit differently. We're not going to talk about head and shoulders and cup and handles. I don't use those. We're going to talk about different kinds of patterns, and we're going to do that today at 2 p.m. Eastern. All right. So in terms of that, buy the dip, that's still something I'm looking at, Giancarlos. Hey there, Julian. What corner of the market is the ISM manufacturing going to hit the most? I'd keep an eye on the Dow. Julian, I'd keep an eye on the Dow in terms of volatility, and then secondarily the S&P, and then IYT, XLI. It's a more broad. There'll be that hot zone will affect the reverberations will be felt across multiple indices, but I would focus more on the IYT, XLI, and the Dow in general. Great question. Hey there, Alan. Commodities look weak this morning. Will they have much influence on my ADM position? So if we have grains moving lower, ZC, ZS, or in general, just traders not wanting to be long ADM anymore, as the trend has for the first time since the beginning of the year started to look a little bit more neutral, not as bullish. Yeah, there's a chance that some of these commodities breakdowns that started on the 21st, 22nd, even though ADM was able to survive that volatility, there's a chance that it's going to keep those the unwillingness to be in these inflation and in these commodities uptrends. It's likely, not likely, it's possible that the reverberations, gosh, I can't even speak today, more coffee. So it's very likely that those reverberations are going to continue to move through that corner of the market of inflation and commodities, and we might ultimately see the point of validity on these breaks. So yeah, probably. I have to be aware of what is most vulnerable in my book. And I think those are still pretty vulnerable, Alan. Any of the uptrends around commodities and inflation have been vulnerable. And I've been doing less of those, but we'll probably stop them altogether this week. Again, if you think about it, you might say, Rog, how much time do you give something? Well, remember, and this is important, we've had these trends in place almost all year long. It's May. So we're January, February, March, April, and definitely February, March, and April. So 3 months. And really in the matter of about 3 days, 21, 22, and 25 of April, these fell apart. So these are barely 1 week old in terms of these trend breaks. I don't abandon them completely, and I certainly don't reverse, right? Stop and reverse usually is a very bad tactic, low probability tactic. So if you think about how long these trends have been under pressure and or broken, this is less than a week. But it's definitely those blue grab candles, the break of the wave, the yellow trend, the neutral trend. Those are all hints to start to reduce position size and start to rebuild the watch list elsewhere, which sort of brings us full circle to got to rebuild that watch list. All right. And, I think the same is going to go for things like GDX and GLD. These are the two non-trending trades in my book. So everything else that we have right now has been a trend. We're taking advantage of pullbacks. We're taking advantage of rips in what we like to call double green, bullish momentum, bullish trend, and double red, bearish momentum and bearish trend. And so these are the two that are probably the most vulnerable. We also acknowledge non-trending markets by saying, look, we can keep a tighter stop here. There's only one entry here. We're not scaling in. We're usually going to be about 50% budget on some of these. So the idea is to control the risk in a non-trending market that could break down like this by having smaller position size, more conservative entries, and acknowledging, hey, this is a non-trending entry, not a trending entry. So a short the rip on ITB looks better than GLD. A buy the dip in natural gas stocks or natural gas is a better setup than this. So we do prioritize the trends over the chop. but I don't mind to trade chop. But I know also that if I look at my book of trades, all the open positions that I have, and more than say 20% are yellow neutral trends, I'm wandering too far away from high probability market conditions. So thanks for the question, Stephen. We may end up with paper cuts here. Absolutely. And for those of you wondering, gosh, Rog, there's some trends that are suddenly ending. Absolutely. The tricky part, again, of trending markets is eventually they're going to stop trending. And there are going to be traders like myself who've been in them all year who say, okay, that's the last trade. But others traders are going to say, Rog, I didn't get those prior 2, 3, 4 entries. And this was my first trade in the trend. And this is where I say, I hate, the first taste for any trader to be, that just stung. Yeah, that was bitter. That wasn't fun for any trade that I put out there. But you're getting the best lesson you could possibly get, because a lot of traders trade uptrends and they don't know that position sizing and risk management is everything. And they find out later on, sometimes the hard way, because as one of my mentors said, they make the grave error of mistaking an uptrend for brains. If you're tackling this market now and you're with discipline, taking those small losses, I know it's not fun. And I know it's not just a lesson, but it costs us something too. Our capital goes down. But I'll tell you what, traders who can handle this market now, you can handle anything. So right now you're going through your hell week. You're going through that mini buds. This is your way to becoming Navy SEAL trader. And it is tough and it does sting, but please pay careful attention to your risk tolerance. Pay careful attention to your discipline around watch list building and position sizing, and your discipline to recognize your stops, because those are the lessons that great traders carry with them throughout their career. And you might be getting those right on the very first day with me or in your trading. And I know it stinks, but the light at the end of the tunnel is you're going to learn things quickly that most traders learn much more costly later on. And a lot of times those traders that learn it later on, they never get their confidence back because they were so busy patting themselves in the back for their brilliant trading when it was really an uptrend. When they finally get stopped out, their confidence is so shattered, they have a very difficult time coming back. And I've seen it, and that's unfortunate. So in a weird way, it's a great thing, but it still stinks. I totally get it. Would Facebook qualify as a short the rip? Yes, it would. It would. It's still in a downtrend. You could now that it's double red again, it's short the rip. When it was yellow, it was overbought, oversold. But yes, Jay, it is. Absolutely. Good eye. Robert asks, do you change what indicators you look at for intraday versus end of day or swings? So I don't change as much as I add a few. And Robert, if you head on over to the Simpler Trading channel, let me see if I have my web browser up here. Yep. And let's go to the YouTube. So many of you are on YouTube right now. And if you head on over to the Simpler Trading YouTube channel, you'll see that there is right there. So 9 days ago, Robert, that got posted. Day trading indicators. Check that out. You'll notice I don't change settings. It cracks me up when I see traders, especially new indicator builders. You can really tell someone who's just sort of getting into indicator building or maybe built their first, because the settings are going to change constantly because they don't know the difference between optimization and curve fitting, and they end up doing the latter, which is what we all been there. But it's a sure sign that someone's really, really, really green at indicators, right? So I was once that way too. Luckily, it was 30 years ago, but we all go through that. So if an indicator setting has to change again and again and again, stay away from that indicator, right? It's being curve fit and you're just going to struggle with it. The next stage of indicator building is to accept that indicators must be universal and robust. They must work on everything and they must work well. And that means that we're not switching it up constantly. So you'll notice what I do is I add volatility. I use an intraday time-based volatility tool to my day trading. We use some time emphasis to day trading because time is important to everything, but it's really important to day traders. So I'll add a few things, and you can see I break it all down in that video. And so you can check that out right there at the Simpler Trading YouTube channel. Okay. So great question, and thank you for that. All right. Next up is, hang on, gang. Let me catch the next symbol here. Do I have a theory as to the overall regime recently changed? Why the dollar? I don't quite understand the first part of your question there, Mark. I don't understand the regime recently. I don't know what that means. However, if feel free to ask me at the next show. Pretty much out of time here, but why is the dollar moving higher? Monetary policy, and this is not so the dollar. This is where all trends end up eventually. Right. And I can only say this because anyone who's in the futures room or in the Sector Secrets Mastery has been in this trade for months, not days. Macroeconomically, last year, and this is a great question, and thank you for asking it, Mark. Q3, what did Powell do? He acknowledged, oops, I'm wrong on inflation, right? Now they realize it's not transitory. It makes me laugh even to say. We knew then that was the what? Harbinger to higher rates. That was a shift within the mindset, within the messaging, and ultimately the policy of the FOMC. Generally speaking, central banks that are hiking rates, not just the US, but any central bank, hiking rates is going to be a bullish catalyst for the currency of that country. Hence, the dollar is going to strengthen. The most direct route into the dollar is not the dollar index. That's oftentimes a very common mistake. The most direct route to dollar plays are not the dollar because it's a dollar basket, right? The most direct play to the dollar is the euro, is to get long puts, FXE, which we've been in the mastery, is to get short the 6E, which we've been in the futures room. So the idea is you play the most direct path into the dollar. Now, when I say direct path, keep in mind that the dollar index basket is euro, 58%. Or thereabouts, pound, yen, and then some fairy dusting of some other currencies. When the dollar is stronger than the pound, the euro, and the yen, now the dollar index makes sense. The reason that all of a sudden the dollar is accelerating is really twofold. One, everyone's talking about it. And this is the later stage of this trend. This trend's been in play for at least 2 months, through March and through April. So now the latecomers are finally realizing, oh, the dollar's breaking out to new highs. So now you get your momentum players catching up to almost 4 to 6 month old macroeconomic trends that dovetail with the technical trends really starting back in November, December of last year, right? And so it's just the way in which different traders, there's nothing right or wrong or bad or good. It's just the way different traders end up with a narrative on their radar, right? So if you follow macroeconomics and then you confirm them with technical analysis, which is what I absolutely recommend most traders do, because macro alone is not a good idea. Technicals without macro is incomplete. So when you see those dovetail, and that's exactly what happened in things like 6E, 6B, and then again, remember, DX only makes sense when those other currencies are weaker against the dollar. So it's been making a big move for a long time, but then things go parabolic when they go sort of mainstream. And that's almost always what happens to a stock, a futures contract, a currency, anything. Bitcoin, things can happen in a quiet technical way, but all of a sudden, usually because they've broken certain thresholds, they become much more mainstream. Everyone FOMOs in, and there it is. So Mark, I hope that makes sense. An awesome question. Remember, if you can dovetail macroeconomics and technicals, this is a multi-month trend, right? That we're still going to take advantage of. So that's what's happened. It's become obvious to basically the mainstream traders. And that's okay. That's okay. Just remember, when a central bank first starts shifting monetary policy from, say, neutral to hawkish, or hawkish to dovish, or dovish to hawkish, whatever it is, lower rates are usually bearish for the currency, and higher rates are usually bullish. I hope that helps. I love currencies. I've been trading them for many, many years. So I love them in terms of what they demand of us to understand what's happening with monetary policy, which is the most important macroeconomic pillar. So thank you very much for the question, Mark. Sorry, gang, I ran over. Go enjoy your time in the rooms. I will see you all in the Sector Secrets Mastery bonus session about patterns at 2 p.m. It is not too late to join us. If you want to join our crew, simplertrading.com/join/sector. All right. Be good to each other. I'll see you tomorrow. Same time, same station.